Hello, everybody. Happy Thursday. I thought I would do a little live stream about a question I got an email about from a friend. Let me just make sure that this thing is working. Well, I can't tell if it is. There, yeah. All right. So, all right, I'm just going to throw the link in Discord real quick, too. All right, thanks for your patience. Share my screen. Okay. All right. So, the topic today is going to be about expiration and a little bit about how basically market makers manage their risk and how they think about expiration and managing their delta. But it kind of starts with a broader question. So a friend of mine he started his career. He spent about a decade doing equity long short investing, and then he's been for like 10 or more, probably 15 years now. Since then, he's been running a family office, and but he's not an options guy. But he's, lately, for the last few years, there's been so much discussion about, uh, what do the market makers have on? What's their inventory? How does that affect flows? Kind of all that conversation. So, uh, I guess he's been kind of checking out some of that stuff, and so he asked me a question. The question he asked me was, first of all, let me shrink this so it's like we can not have could have like the right amount of attention here. And then let me see. Sorry, I'm just checking to see if this is actually legible. I know that the resolution could sometimes be a little difficult here. Let me. Okay, that's not terrible. Sorry, so I have this like very narrow screen from top to bottom, so it's wide. Okay, so the question he asked me was, let's say that a fund had puts. It sounds like puts maybe short 5% below the market. And come March 21st, I guess he was talking about tomorrow's expiry. Come March 21st, the spot price goes below the put strike. So he says, do they exercise and assign? It's not clear here whether long or short, a little confusing. And then what exactly? This is mostly me being curious. I get all the math parts, but at the end of the day, there's a bag holder that has to hedge. No. Um, are there weird second order effects? And so I thought I would just address this question uh, a bit broadly, and then I'll talk about a little bit of like practical expiration stuff. But the first thing, so this is how I responded to him. So the quick answer is this: um, let's just, unless there's a gap, let's just like put a gap off the table. What I'm calling a delta neutral warehouser, you could think of as a market maker or somebody that is running trying to run an options trader running a market neutral or delta neutral book. They're continuously adjusting their delta, and the it doesn't necessarily mean that their adjustment from this delta adjustment from the last delta adjustment is a whole day. That we're constantly adjusting our deltas um, intraday. So uh, it ends up looking kind of smooth as far as what your delta, like you're keeping your delta pretty flat all the time. So the question of like, if the market were to go down 5%, if it gaps down 5%, then yeah, that's going to be a discontinuous sort of move in your delta. But if it goes down gradually 5%, your adjustments are just the difference between your adjustment right now and say your adjustment 2 hours ago or 5 hours ago, whatever it is. So it's not that you have all this delta impact into the market. And market makers are usually passively working deltas. So they have some sense of I don't want to be running delta risk that is too large, because then it swamps. From a risk point of view, it kind of swamps the point of what they're doing, which is vol trading. So they're not, they don't want to be directional traders. So they're passively trying to get out of their deltas. I think a decent rule of thumb is that market makers, when they're passively hedging, are probably trying not to be more than about 1% of the volume in the stock. So they're trying to minimize their market impact. Again, the delta hedging is not, you can't just assume that there's going to be this large delta impact, because they're continuously working their orders to reduce their overall delta that's being spit off from their gamma and their vol books. But the other thing about this is that, and this kind of goes back to, I talked about this on in my interview with Corey when I went on the Flirting with Models podcast. But there's an idea of like, do you want to hedge? Do you want to manage your risk? To what degree do you want to manage your risk locally or over large moves? And if your Greeks are a really good guide for your local risk. If the stock goes up $1, I know what my delta, gamma, theta, vega are. But your Greeks can change a lot on a large move. And so it's not just that market makers are managing to their Greeks. They also have their peripheral vision, their eye on, well, what does my book look like if I shock the position, both in direction, vol, and time? So, if I move the date forward a week and the spot is here and the vol is here, and we can sort of have this three-dimensional grid of what their risk would be, and they will manage to that. So their local risk might say that they're long delta locally, but when they look at the scenarios, they're like, I actually feel like in a lot of these scenarios, I feel like I'm actually short. So their delta will reflect that, and it'll look like a lean, or they'll call it a lean, and the risk manager might come over and say, "Hey, I see that you're running this long delta," and the market maker or the trader will say, "Well, it looks like it looks like I'm long right here, but over this range of scenarios, I would actually be short if I didn't have this delta lean in my book." And some of this could be programmatic, where they have where their assumption about what the deltas are of their options might be embedded in the models themselves, like ideas like skew delta, or this really comes back to how you think spot vol correlation works. And again, even that idea is pretty local. You might think that vol comes in 1% every time the spot goes up 1%, which what I would call like a quote unquote constant straddle regime. So if you think that that's the case, that might be true locally, but you don't think that if the stock goes up 10%, that vol comes in 10% necessarily. If the stock goes up 10% in a day, you don't think vol's coming in 10%. So that doesn't hold linearly across the entire range of price changes. So there's an element of judgment here where you're like, well, my delta says this, but I actually think it's this. And part of that could be just knowing the flow and whatever you're trading, kind of having an idea of where, like, as I like to say, like where the bodies are. So that could be a conversation you'd have with your risk manager and say, I have this lean in here because I think my true delta is this, and the model's sort of not capturing that. So anyway, so market makers are they. I would say that they're looking at their risk not just on their Greeks locally, but at their they're looking at their risk discretely too. So uh, so this is where we're going to get into expiration. So I'm going to take this example, just walk through an example, and I think it'll make it a little bit more clear. So here, I just like this is a fake-ish sort of example. Like maybe Tesla is probably around 233. I froze the values here. So we got a stock price in here of 233 for Tesla. We're using the March expiration. The numbers are made up. I'm putting in. We can actually ignore all this. Okay. We don't need to look at any of that. Okay. So I have a price in here of 233. I'm saying there's 2 days. I'm just overriding the options here. So it's saying two days to expiration. So you can think about this as it's Wednesday's close, last night's close. This is for the Friday expiry. I put an 80 vol in here, and we get, just using European options calculator, we get these values using an 80 vol, right? And I'm assuming no skew, like every strike is 80 vol. Okay, so the 235 strike is the closest to at the money, where we have a spot price of 233. And I'm saying this is our position here. Let's just pretend that's our position. So everyone, based upon these vols and 2 days to expiry, these are your Greeks per for the option. You have put delta. I put your call delta, your put delta, your vega, your gamma. I didn't put your theta in here because the way this thing works, it thinks that there's actually 1 day to expiration. The way it doesn't matter. Don't worry about the theta. By the way, the way I calculate theta in a lot of my sheets is to say, rather than use the Black-Scholes calculation for it, I price the option on tomorrow's days and price the option on today's days and just take the difference, and the little hack that I use in here rather than using the VBA for that. Anyway, here's our positions. So your straddle here is right around 11, somewhere around $11, 235 using 80% vol. Remember, 80% vol, that's a 1 day standard deviation move of 5% per day. So that's 80 divided by 16 is 5. So 5% per day is the daily standard deviation on something with 80 vol. And I just made this up. These strikes, the bottom and the top are about 10% out of the money each, and there's 2 days to expiration. Okay. So these are all the positions that we're going to pretend we have. So, you're short these 50 in the money calls, you're short these 50 in the money calls, you're long 100 of these out of the money puts, these 220 puts that are out of the money. You're on the upside here, kind of a big position here. You got your long 300 of the 250 calls. For these are, $17 out of the money. Remember, spot price is 233. And then what we do here is and this is how market makers will look at their books. They will usually, like the way I looked at risk is all of this was collapsed into just these. And the way it worked in my software is you could hover over the net position and it will show you the breakdown of calls and puts. But because of put call parity, outside of funding concerns, whether it was a call or put does not matter. This is all that matters. And this is going to be really clear very soon why it doesn't matter. So all you care about is your net position on the line, on the strike, or on the line, as we say. Okay, so all of these Greeks, if we sum up all these Greeks, so this is if we take all of the Greeks times the position and times the position sizes, they sum up to this. So this book is long 10,000 deltas. It's the equivalent of 10,000 shares of the stock. It's short a little bit of gamma, short a little bit of vega, and it's short about $24,000 of time premium. Time premium being extrinsic value. So I'm subtracting out all the intrinsic values, and you're just left with this is how much pure optionality this particular position is short. Okay. Now, as you're coming closer to an expiration, these are your Greeks. But this is not a very useful way to look to understand your risk, because the closer you get to expiration, the more discrete the risk becomes. The question becomes, what is my delta at expiration as we cross over the strikes? Because my position is going to flip or change. It potentially flip, but it will certainly change depending on your position on the line. And it will change based upon your net position on the line. Okay. Again, it does not matter if it's a call or put. It's just your net position. So if you are long, so this is the basic understanding. If you are long a strike, it doesn't matter if you're long calls, long puts, doesn't matter what the actual position is. If you own the strike and the stock expires higher than the strike, you will become longer. If you expire below a long strike, you will become shorter. If you're short a strike, the exact opposite happens. If you are short a strike and the stock expires above that strike, you will become shorter. And if you are short a strike and the stock expires below the strike, you will become longer. In other words, it perfectly reflects what Gamma would have predicted. Right? If you go through a short strike, your position goes in the opposite direction of what the market's doing. And if you are long a strike, like you would have been long Gamma, then your position will go in the direction that the market is going. Okay, so let's actually see how this works. This is how a market maker, options trader will actually look at their risk going into expiration. They will think about their risk in terms of, what is my risk post X? That's what they'll say. What's my post X risk? What does my book look like after expiration? And they will do this in a very discrete way. So here we've got 2 days to expiration, and we've got all these risks. I'm long 10,000 deltas. So let's go here, and we'll say, you know what? Let's pretend we're delta neutral. I'm just going to short 10,000. We're going to say we're short 10,000 shares. Market maker sees this book, says, you know what? Let's sell 10,000 shares. Now we're long only 456 deltas or 456 shares. That's well within our risk limits. No problem. Okay. So we run a book. We're short 10,000 shares. Okay. Stock is 233. What happens if we expire at 233? So what I'm going to do here is I'm going to just put a DTE override, and I'm going to just simulate as if expiration came. The easiest way to do this in this particular spreadsheet is to just say that the time to expiration is something like 0.00001. If I put in 0, all the option calculators break. So I'll just put that. And you can see here immediately, the first thing I want to bring your eyes to is all the options go to intrinsic, right? Remember, stock is 233. So the 235 put goes to $2. The 230 call goes to $3. All the options go to intrinsic value. All the deltas go to 1 or 0, right? All your call deltas here went to 1. All your put deltas here went to 0 from the 230 strike down. All your put deltas here went to -1, and all your call deltas here went to 0, right? From the 235 call up. Okay. So now look what happens. Your position delta you are now short 5,000. Okay. So what's happening here is you are short the 230. Remember, you're long the 235 strike. You expired below 235, right? So the 235 strike here is kind of spitting off, like it just goes to 100 delta. So it's as if like you get all these puts and sort of all the other things kind of like wash out. So your net delta became short 5,000. So if we expire right here, if we roll the day forward, our post-X risk is that we become shorter 5,000 if nothing happens, shorter 5,000 shares. So the way this will be, and so you can start to imagine what a risk report might look like, where you have a grid of at every stock price that is between strikes, post X, what is my delta? Okay, and so we're actually gonna do this. Let me see if, yeah, I think you guys can see that. You know what? Let me shrink this just a bit and then widen it. Okay. That looks like you can kind of see it. Okay. All right. So at 233, so we're going to, what I did here is I just said, here's all the strikes. And what we're going to do is just say in between the strikes, and I just arbitrarily picked the midpoint, but basically in between the strikes, what's my delta? So at 233 at expiration, I would be short 5,000 shares here. Okay. So that's my risk. Post X, nothing happens. I'm now short 5,000 shares. Okay. Let's do this. All right. Let's put this down to 228. At 228, okay, I become long 5,000 deltas. Now, does that make sense? It does make sense because look here. This is our position on the 230 strike. If we cross the 230 strike, we are going to get longer because we are short. If we're below the strike, we're going to get longer the number of shares that correspond to our net option position on the strike. This is so we're going to get longer 10,000 deltas because we're short 100 options on the line. Okay, so at 227, our position is long 5,000. Okay, let's go to the next thing. So we'll go to 223. 223. Our position is also long 5,000. Does that make sense? It does, because there is no position on the 225 strike, so nothing should change. Nothing should change. This strike has no impact at all on our post-X risk. Okay, let's drop. So first of all, we can look at this and say, okay, I'm long the 220 strike. What do I expect to happen? Well, I expect that because I'm long the 220 strike net, I expect that my delta below the strike is going to get shorter 5,000. So I expect that we're going to go from long 5,000 at the 220 in the 223 area. I think we're going to get to flat delta at 218. So let's see. I'm going to put 218 in there. That's exactly what happens, right? We get flat delta. We're zero delta here, okay? And then at 217, sorry, that's where we are right now, or 218. And then once again, I do have a position on the 215 strike. I expect to get longer yet again if we go below 215. So if we go here to 214, and there I become longer. Sorry, this was, that is zero. And then this becomes long 5,000. And then below 210, we have no position on the 210s. Right? No position on the 210s. So if we go to 208, I don't expect my delta to change. It's going to still be long 5,000. Okay. And that's exactly what happens. So I'm still long 5,000. All right. We can do the same exercise on the upside. All right. So we started at 233. So let's go up to 237. So we're going to go through this strike. So I think 237, remember at 233, we're short 5,000. At 237, I think we're going to be flat because we're going to go through 50 options here. That's exactly what happens, right? So our delta is 0. We get longer 5,000. Okay. At 240 to do 242. Go look at the strike. We're short. Okay. So this is interesting. We're short 100 options on the 240 line. So if we go through 242, I'm going to be short 10,000 deltas. Okay. And what do we see? It's exactly what we see. Put 242 in there, shorter 10,000. Now we're short 10,000 deltas here. Okay. And add a 0. All right. And then, sorry, this should have been 0. And this should be short 10,000. That thing putting a dash instead of 0 is just throwing me off. Okay. All right. And at 247, well, we have no position at 247, right? So I don't expect anything to change. We're still going to be short 10,000 there. Okay. And we can confirm that just to be thorough. Okay, nothing changed here. This did not change. Okay, at 250, we're long 250 options on that strike. So we're going to go short from short 10,000 to long 15,000. We're going to pick up 25,000 deltas through 250. So if I go 252, bang, 15,000. All right, so this becomes 15,000. All right, so I think at this point you can kind of trust the process here. Every time you go through a strike, your position switches by whether you're long or short the options. Again, does not matter if there's calls or puts. Okay, your position will flip. If you're long the line, your position is going to flip in the direction of the market. Okay, so this becomes the risk that the market maker is looking at. So at 233, they're short 5,000. So, and they're longer as we go down, and then they're shorter as we go up. So they may look at this risk and say, I kind of want to smooth this out. Like maybe I think this, there's a little bit more skew to, like, this could just be opinion stuff. Like I think that, the market, if I'm concerned that the market could possibly, I'm more worried about the upside than the downside, then maybe I lean a little bit long. So here I will be flat. Here I will be flatter than this. And however, if I'm wrong, I'm going to be extra long down here. But, they're going to look at this and they may change. They may lean one way or another, depending on which way their deltas are. Now that, what that means is that, so this kind of gets back to like this idea of like, oh, there's all this open interest on this line and anticipating like this is what's going to happen when we get to that line. But the thing is the market makers know that too. We've known this forever, really. It's like all this talk of like, we're always looking at it like this. So the fact that you have an opinion about what's going to happen at a certain strike because of the open interest that's there, well, the market makers anticipate that too. And so they are massaging their delta, looking at their discrete risk as they get down there to in anticipation of what they think that what might happen when they get down there. So you're sort of, it's like your judgment against theirs. Like you're like, oh, I think that when we get down there, everyone's going to be short because we're going to go through this line and all the market makers are going to be short. But they knew that too. So, how are they going to manage their book? Sort of understanding what the other open interest is outside of them, what their open interest is. Not to mention that you don't really know what they have on. Like you're looking at SPX in any very large trading firm that's got like a very that has big SPX complex positions on. Many of them are running dispersion books over the top of this. So you're like, oh, if the S&P gets to 5,600, the market's going to be short all this gamma. Well, if the market makers didn't just sell all those options naked, like they're running core books, right? So they're buying single stock gamma against it. So the question is the moneyness of the stuff that they bought against the stuff that they're short, is the money, are those moneynesses continuing to line up? It is a very messy problem. Like if I sell 25 delta SPX puts, should I buy the 25 delta single stock puts? Should I do this in moneyness terms instead of the 10%? If they were 10% out of the money puts in SPX, should I buy 10% out of the money puts in the single stocks? How do I think these things behave? Like this is the whole core trading business is super messy. But the point is they're not just naked short these puts. They own single stock. Very likely they own single stock vol against these puts that they're short. They have VIX positions on in addition to this. Like it's just all one big, I like to call it the triangle, but it's all related. They're not just naked short SPX downside. they're short that downside because relative to something else, it looks like a good trade. Now, so they're exposed more to the basis of those behavior of those relationships than they are the actual net gamma. So I don't understand fully this like this concept of like computing gamma just on the SPX when it's like, are you going to compute the gamma that they're long in the single stocks against it? Uh, or do you know how much net? Maybe they are net short gamma. That could certainly be possible, but how do you know how much net short that is when you're computing how much delta there is to buy or sell? So anyway, that's the point I'm really trying to make is that the market makers are not just they are looking at their risk over ranges of possibilities. Like here, and this is not, I'm giving an expiration example, but they're doing this for everything all the time, right? They're running shocks on their books where they're looking at what happens to my position if the stock goes here and the vol does this, and they're doing it at the portfolio level. And yeah, there's a lot of assumptions. I kind of wanted to get to, you do get examples of pretty hairy stuff. Like expirations are always a little bit hairy, right? Because if a stock suddenly goes through a strike, or you're in a pin situation, the risk does become very discrete. So I kind of put this in here as an extra nuance to I wrote this back to my friend, but I'll just kind of read it a little bit up. But pins can screw with you because, well, think about let's say you're short Microsoft, you're short the straddle in Microsoft. It pins the strike. If the stock finishes above the strike, or sorry, like the stock finishes on the strike, but you don't know if you're going to get assigned on either the calls or the puts. So what will happen is, you're running this giant book. So, and everything that's near a pin, you can define that however way you want. Like, hey, a stock, any stock that's within 10 basis points, 25 basis points of a strike, you may define as this is a pin situation. So let's say I'm Microsoft. We'll use Tesla because I got that up here, right? So Tesla is $230. Tesla expires at 230 and a half. You're short the 230 straddle. Yay. You probably made a lot of money. You're short the straddle and it's expires very close to the strike. So when you look at that, you're thinking, well, I'm short the strike. So my presumption here is that I'm going to get assigned on my short call and my short puts are going to be abandoned. That's an assumption. What if the futures are down 75 basis points after the market closes? Okay, if the market, so futures are down 75 basis points after the market closes, you might bait Tesla. Well, first of all, Tesla trades still after hours. So let's say it closes 50 cents above the strike. Futures are down after the close. Tesla is down after the close. So now Tesla is trading 50 cents below the strike. So your delta is going to flip quite a bit because now you're thinking to yourself, oh, what's going to happen? I'm actually going to get assigned on my puts and my calls are going to get abandoned. And part of this could be, who's the other side of this open interest? If the other side of the open interest is a professional, if you think it's a professional, then they're most likely going to act optimally. If it's a bunch of retail on the other side, sometimes they make mistakes. So they may not abandon when they should, and they might exercise when they shouldn't. An interesting thing, like on my IBIT puts, I was short the March 14th last week. I was short the March 48 puts. The stock closed about 48.14. I actually got assigned on about 90% of the puts that I was short, right? So, and of course, and Bitcoin itself trades all the time. So it wasn't unexpected that I would get assigned on those puts because Bitcoin kind of traded lower. And so, and of course on Monday, IBIT is trading below the strike. And so when I get contraried in that way, when I get assigned, when I don't think I'm going to get assigned, you're pretty sure that you're going to be sad on Monday. That's just generally how this works. So in any case, when you're in these pin situations, you got to pay attention to what the market's doing after hours. The futures are doing after hours. You could have a risk report that says if the market's doing this after hours, and I beta the move in the stock. So let's say I got a company that I have a stock that position in a stock that's moves 1.5 beta to the S&P. So if the S&P is down, uh, 20 bips after market, I say I think my stock is down 30 bips after market, and then let that dictate what I think my risk is going to be on terms of like what. Well, first of all, maybe there are options I should be exercising if I'm own any options that pin, and maybe there are options I should be abandoning. And what do I think the counterparty to the open interest on my books, what are they going to do? And um and so you might look at your post-ex risk and you try to look at your strikes and be like, I should probably exercise about 75% of my options, because I think in most scenarios that gets me pretty close to flat. Like if it's a really close call, you may just pick to exercise or abandon the amount of options that kind of makes your delta feel smooth over many scenarios. So, and this was, I kind of joked to my friend here, but I remember being in the office after hours on a Friday, and it's like, you remember it's like running giant option books, and it's like, oh, you've got 300 pins that you have to go decide what you want to do on the strike. So it's like, grab a couple trader buddies and go through the list, and hopefully between all of you, you can get out of there within an hour after the market closed or something like that. But anyway, the point is that it's, these things that we understand about the market, like, oh, this is what the open interest is there, the gamma and everything like that. The market makers know that too, and they're all sort of managing their risk to that, and trying to keep it smooth. And the thing is they have a much better picture of the whole market, right? Because they know, they might have a sense of like what's going on in the deltas of the names that correlate to the thing that you're looking at, like the S&P. Like S&P puts, well, they know what's going on in the single stock puts that best correspond to when that 25 delta put in the S&P was put on, right? So they have an understanding of that as well. So anyway, I hope that this was kind of helpful. I hope that there was a little lesson in here about put call parity, and how it's kind of neat that the net position on the line, that's what determines if your position will flip. And the reason you do need to know whether it's a call or put is because when you get down to it, you do have to decide, in this case here, I'm long 250 on this line, but I'm short 50 of these puts. So, I do have to anticipate, okay, what's going to happen if we're near the strike? Am I going to get assigned on these? And based upon, like, if I'm going to get assigned on these, I'm going to get longer at that strike. Let's say we expire right at 255. If I get assigned on these, I'm going to be getting longer. So maybe I don't want to actually exercise all 300 of my calls if I expect to get assigned on 50 of these. So but the thing is, you have gamma at the strike, right? Even at the close, right? You can, if you wanted to, you could kind of trade futures around it. So like if the futures are above the closing price, you actually have, you're taking delta or basis risk, but you could sell futures, because what you can do is, if the stock goes above the strike, or the futures go above the strike, you have the right until, it depends, every firm's got a different cutoff. Well, let's say your right is until 6 p.m., right? The market closes at 4 in New York. You have the right to abandon or exercise up until 6. So you could actually continue to trade. The futures are open for another, I think it's like 45 minutes after the close. I can't remember. But you have gamma for an extra 45 minutes, which really brings up the question of like, what, sort of like, this gets into vol time stuff. It's pretty interesting, but like, I used to trade crude oil options, and you have European exercise options that are automatically exercised right at the close, and then you had the American options. And so, for the most part, there's no difference between it. But in a pin situation, like let's say you think you're going to pin early in the day, the American options will start to trade. They could go to a dime premium to their European counterpart because you're getting an extra couple hours to decide what to do with those options, right? So if the stock goes above the strike, like take this scenario here, the stock goes above 250, you can sell the stock because remember you're long, you're getting longer. You can sell the stock. Let's say the stock goes to 251, you could sell it, and let's say after market the stock then drops to 249. Well, in that case, you don't have to exercise your 250 call. You could just buy your stock back for 249 instead of exercising your call. So the optionality here allowed you to, another way to think of it is like when the stock went from 250 to 251 and I sold the stock, I turned my calls into puts for free. And now if the stock drops down to 249, I can just buy the stock back for 249, and you could literally just scalp your gamma all around the strike if you're long it, even after the market closes. So the expiration can be really pretty interesting. It's kind of crazy that every day is an expiration now with the zero DTEs, but in any case, I hope overall this was educational, and like I said, I'll it's recorded and it's going to go up on YouTube afterwards if you ever want to revisit it if I went too fast or anything like that. So anyway, thanks a lot. I will see you next time.